Good morning. Thank you for joining us for our webinar today. We are very happy to discuss this topic, which we think is very much moving markets these days. Of course, we have seen a lot of euphoria in the month of June that then completely turned. The two main arguments are, of course, AI and QT. And so we believe that discussing this with Filippo Lanza is going to be very interesting, and I hope you will, you will participate, having for us some questions throughout the discussion. Filippo is is the founder of Numen Capital, as you know, and the portfolio manager for HI Numen Credit Fund. So we will go through the views and the main positioning for the portfolio. Filippo, I leave it to you. Thank you.
Thank you, Laura, and good morning, everybody, for being here. We're going to go through the presentation, and I think we're going to first talk about our overall macro picture, and then going through some specific trades and position we have on the book. On the macro side, if we move to slide page 3, we basically trying to summarize the two big drivers in the market. On one side, we have the artificial intelligence trend with the valuation, wave that has unleashed. Some could view it as irrational exuberance. Some will view it as absolutely rational. And on the other side, that is clashing with the impending quantitative tightening programs of the various central banks. A couple of things on both sides. In terms of AI, obviously it's very real. We think it will be very relevant and a major driver of a big deflationary wave in 2024 onwards. We think AI will effectively impact lots of what used to be the good jobs, professional jobs. So I think there'll be plenty of accountants, lawyers, fund managers, and other kind of highly paid service jobs that will be impacted. And on the other side, obviously, we need to keep in mind that artificial intelligence is not a new thing. We used to call it with different names, like natural language processing, machine learning, and so on. Now we call it AI, and it looks like a different thing, but it's been there for a long time. GPT is effectively making that much more visible and much more impactful on a personal level, but this has been there for a long time. Now, the interesting thing about this new technological wave is that it's very much like a common good. It's not like when Apple created the first iPod or iPhone. They were very, very unique. Here's the actual opposite. Everybody, whether it's OpenAI, Microsoft, Google, Alibaba, they all have their kind of generic AI model. And then on top of that, different businesses will create their own specific customized version. That means that it's going to be very difficult for each single company to actually retain lots of that pricing power. And for lots of companies, whether it's Google or Microsoft, it could improve certain things, but it could actually be at the detriment of other revenue streams. So overall, I would say we view AI right now as more of a irrational trend of buying everything in the market. And I think anything related to AI, and I think will eventually push the market to pre-COVID tops, which I think are going to be pretty much unsustainable. The one thing that AI is not being priced for is the opposite, which is, what we think is a real driver, the real impact, which is going to be a deflationary wave coming 2024. In her own words of Cathie Wood, obviously which is not exactly the value investor you have in mind, but she's been saying since 2014, they believe NVIDIA was there for the AI future and everything else, but they think at 25 times expected revenue and maybe price ahead, and we're already above that now. So overall, I think AI, there's been a lot of excitement. Part of that is because the structure of the market has changed. There's a lot of retail participation, a lot of retailers buying daily call option on the market, then pushing the market. So there is also that aspect of kind of meme stocks playing. But I think AI is very, very real. I don't think we've seen anything yet, because there's probably been $500 billion to $1 trillion invested in AI startups. And I think we'll see plenty of that coming through. The macro impact of that will be deflation. In the market right now, already overpriced. Hence, position-wise, we're quite short, both NASDAQ, Nikkei, and a few other sectors where we think the valuation are, they're meaningless at this point, including names like Tesla. On the other side, obviously, we have QT, and QT is at the opposite of the spectrum for the valuation. Basically, QT is the shrinking of the balance sheet of central banks. And remember, we've been talking about QT for the last year. The reality is that we've been living through one of the best moments for quantitative easing globally, because US didn't really do QT because they had the debt ceiling restriction on new supply. Bank of Japan has been injecting enormous amount of cash to protect the band. China has been injecting a lot of cash, and ECB has been talking a lot about QT, but at the end of the day, kept on going with PEP and so on. So with the notable exception of the United Kingdom, that has actually been doing proper quantitative tightening, as the Bank of England selling yields, and we've seen what happened last Christmas, and keep on selling yields. With that notable exception, the rest has been a massive QE. Now that is changing. And if you look at page 4 on the chart on the M2, the monetary aggregate supply, that growth is terrifying, because that is basically collapsing. And we haven't really seen that impact, but we think we're going to see between now and the fall of this year, we're going to see plenty of pressure on risky assets, especially now that we have this overvaluation due to AI. This goes within the context of global economic surprise being quite disappointing. And if I look at the market, I look at credit, credit is not that excited. Credit is quite nervous because they know the cost of funds is going to go up, liquidity is going to go down. And this AI thing sounds a little bit like an El Dorado rather than a real thing. Lots of companies will benefit from it in terms of cost reduction, but we believe it will be more companies where the revenue is going to be under pressure in terms of pricing power than the ones that are actually going to make more revenue on it. So if we move away from page 4, and we can go into the specific macro trades. Now, on the Fed side, obviously, the Fed is like the ECB is truly in a bit of a dilemma, because on one side, the inflation is still very, very stubborn. The economy, the employment levels are still very, very robust, very solid, and they have a situation where the market is creating and making the monetary condition, financial condition looser and looser, simply because of the valuation, the portfolio effect. So we have a combination of different things. We have the lag effect of the subsidies and the savings from COVID, which is still very much at play, especially through retail. On the other side, we had the central banks, which is hostage to the statistics, and they have to intervene, but probably they are over tightening compared to what will be the lag effect of all of that. And at the same time, they are raising rates in an environment where they're actually shrinking the balance sheet. And that is very, very powerful in our view. We said it for many, many years that QT is the real driver of valuation in the market. I mean, interest rates are pretty much irrelevant. Yes, they're more relevant for UK because they're very much short-term driven, and there's a lot of like borrowing index to short-term rates. But by and large, what matters is the balance sheet of the central banks. Balance sheet goes up, valuations go up. Balance sheet goes down, valuation is going to go down. So we are just at a point where we're going to see the lag effect of interest rate increases all across. And then on the other side, you see balance sheet shrinking. Big question mark is going to be Japan. What is Japan doing? Are they going to abandon their band or not? Because Japan so far has been the real central bank supporting the old quantitative easing effort globally. If that were to change, that will make us very, very bearish on equity valuation in general. We're already bearish and negatively positioned, but we think that could go much, much worse. We move to ECB at page 7, very similar. There is one complication for the ECB. Obviously, Draghi is not there. We have Lagarde, and the corporate governance is very different from what we had before. They introduced this new shield, anti-spread shield, but truly the way it's structured is nothing else than a fast track to proper OMT kind of picture. And so because of that, we view that as very negative. So which means that spreads in the periphery could be very quiet in the beginning, but it could actually get to a barrier where they start jumping just because they got past that point. So especially if the country is in an attack because they're not behaving fiscally, that could actually create lots of issues. And the way the new tools have been introduced is very, very dangerous in our view. The moment we're bullish periphery, we think Italy, Greece, all of that is fine. We've been really bullish Greece and Greek banks, and also Italian banks. But over the last few weeks, we've been reducing massively. And we took out most of the subordinated banks, especially AT1 in the national champions, because we are bearish overall on the macro picture and the QT. Away from that, if we move to the next slide, obviously we see this is what we call distress duration, is what we think is going to be the theme in 24. We think there's a big deflationary wave coming up, building up. 3 reasons. The first one is AI. Second one is the massive capex into energy transition, renewable energy, partially triggered by the war. But that has been billions and billions in capex, hundreds of billions in capex, and that will be visible in the next few years. We've seen it already with our dependency on the Russian gas eventually became a non-dependency on Russian gas. We'll see more of that coming up, and potentially the war, which our view on the war is that we are very, very close to a regime change in Russia and a return to oil and gas trading from that country in the next few quarters. And then thirdly, I think globalization. I think people probably overestimate the tension between US and China. We think the global trade is still going to stay at relatively high level. So, which means we will absorb the shock from COVID. So the 3 things together, we see a massive deflation wave picking up steam for 2024, which means eventually, yes, we're bearish now. Yes, there is QT, but between now and the end of the year will be the time to go into distress duration. I put down here one of the best exemplification of that, which is Austria 2120 bonds. Bonds used to be as high as 140 during the QE. Now they are 40 cents on the dollar. I rarely seen in my life 40 cents AAA with that kind of duration, because that duration is a lot of embedded leverage. Now, if we believe we're going to have, deflation wave coming up, then I think those are the bonds we need to position. And the beauty of this market is that has created an enormous amount of duration. And because now that duration is distressed, you pick up bonds below the 50 cents on the dollar. So that's going to be the trade we see in 2024. Is the entry point now? No. Is the entry point going to be in the next 3-4 months? Very much so. And so that's something we're doing a lot of work and we're preparing for. If we move to the next slide, we still very discerning when it comes down to macro. There is a lot of macro stories where we're negative. Our investors know we've been structurally bearish on China. We express that via the short on the yuan and short on credit for swap in China. From time to time, we use Hang Seng to delta hedge that position. We think China is an inverted pyramid demographically, one of the most exposed countries to climate change. And geopolitically, they're not a challenger to US, are just simply going to have a big competitor locally, regionally, which is India, with whom they are fighting for a lot of resources, among others, water, food. So we think the projection for China over the next 5-10 years is not going to be Taiwan. It's going to be much more Russia and Siberia, because they need to have access to natural resources there, which they don't have otherwise. So at the same time, China economic miracle is being predicated pretty much on just real estate expansion for a country where the demographics are not growing. So we think there's an enormous amount of distress loan and lending there that hasn't been managed yet. So overall, China remains a big structure short. We think it's going to deteriorate even more going forward. Hence, one reason more to believe in the deflationary wave next year, because we think, especially with the new tightening of the political landscape in China, we see Chinese growth to be underwhelming over the next few years. Away from that, we have situations like UK, Saudi Arabia. Saudi Arabia, our view is that the Russian war is closer to the end than to the beginning. Because of that, we do expect oil and gas to be coming back into the market, to be priced to come back to the market. And I think we will see plenty of pain in the Middle East, maybe absorbable, but that's something we are looking at. We're not positioned yet. On the other side, we're quite positioned in the UK. We think UK is unfortunately going to have to pay the bill for Brexit, with structural inflation, which is probably going to be the highest in the Western world and the most structural. Bank of England forced to raise rates in an economy where all the real estate stock is effectively indexed to short-term rates. And on top of that, obviously, we're seeing the exit from Europe in terms of, increased cost of trading and increased cost of goods and services. Overall, we're quite negative. UK, we're negative through the sovereign, we're negative through the banking and insurance sector system. Moving away from that, Ukraine is a big long for us. We like it. We've been establishing that long since the 15, 20 cents of the dollar. We believe we're very close to a regime change in Russia. We think Wagner move is nothing else than the show that you can hire a mercenary army and go very close to Moscow. And there's been a signal. I think the war has been a disaster. If it had been successful, it would have been different. But because it's been disasters, I think, there's a lot of economic interest that want to go back to trade. Our view long-term has always been that China has never been involved with Russia for ideological sympathy, but simply for economic calculation. China's view has always been to consume and weaken Russia to then be able to effectively increase their areas of influence in the north, especially Siberia. China is desperate for food, desperate for land, desperate for water. In the next 5-10 years, China is going to have a lot of challenges of climate change. Taiwan is not their priority in our view. Russia is, and India is even more than Taiwan. So our view is that eventually China is achieving what they wanted to, and that means that the war has played its role for China, so it's less relevant now for them. On the other side, we see the Western world keeps on funding Ukraine, and at the end of the day, any war is a war of attrition. So if you can exclude nuclear intervention, then I think the chances of a Russian withdrawal are increasing day by day. And I think what happened over the weekend just re-emphasized that point. The most interesting part, if I look at the historical precedents, is that we never had a situation where two enemies on the battlefield are in a position where one of the enemy actually control the financial resources of the opponent, which is what we're having now. So the Western world control probably in excess of $500 billion of Russian assets. So whoever's going to come and replace Putin will blame Putin for everything wrong in Ukraine. Eventually, it'll go down into some sort of war reparation and settlement, and that will be pretty easily financed for Ukraine. So that's why Ukraine at 20 cents on the dollar is a very good investment, because their chances of success are very high. Yes, in case of God forbid, nuclear disaster, which obviously we hope the mines are going to be there to avoid that. That would be obviously a disaster, even if it's just an accident, even if it's just a tactical nuke. We hope and we believe we're not going to go there because the interests of China and US are very aligned there. But we do believe that we're very close to a turning point, and we think we almost thinking that the chances of a forced restructuring of Ukrainian bonds, which would have brought the fair value around 50, are probably decreasing, and so there is going to be a chance actually Ukraine doesn't have to go through restructuring. Obviously, Ukraine is very important macro-wise because if the war is over, oil and gas will collapse, would change the monetary policy in the ECB, would very much benefit Germany and Italy in terms of equity. It would be a big game changer from many point of views. So it's something we're very closely monitor on that side. Moving away from Ukraine, obviously Argentina is another play long that we have. We've been building on the bonds in the low 20s. We still think there is a decent amount of value. Argentina is probably, kind of perversely this time a beneficiary of climate change. We think the agricultural sector should benefit from what's happening at the climate level with El Nino. At the same time, the political picture is improving there. The bonds are already being restructured, so legally they're quite robust. We like the carry. It's a smaller position than Ukraine, but we still like it, and we think there's a decent amount of upside there, and probably something that we want to build over the next couple of months, depending what's happening ahead of the election in October. Moving away from that, we go into Turkey. Turkey is a name that we've been playing quite a bit. We remain quite negative on the credit, sovereign, currency, because we think that devaluation is inevitable. At the same time, the equity offers some good upside. So we like this kind of capital structure trade where we're short credit, long equity by ETF. It's a small position, but it's something that we've been playing both in the short and the long, short into the election, and it worked pretty well. And now we remain with a short on credit, long equity. Away from the macro side, which is quite, idiosyncratic in some of the things like Ukraine, Argentina, China, UK. At the same time, on the macro side, like I said, our view is to be very skeptical now about valuation of risky assets, including fixed income and credit, but eventually be a great entry point between now and the end of the year into distressed duration. And the longest, the better, the higher quality, the better, because we think 2024 will see plenty of deflationary pressure. Away from that, on specific name idiosyncratic plays, the first one that we want to talk about is Telecom Italia. Obviously, yes, there is quite a bit of beta because very levered name, but at the same time, we think the main idiosyncratic play here is that the government wants to have control on the telecom network. We think that need is being made very clear by COVID and is become even more pressing because of artificial intelligence. There'll be a problem that every government will have, whether it's China or US. They'll have to control the telecom network. It's going to be the one of the few potential gates that they can close when it comes down to artificial intelligence. We think also the regulatory environment is going to change completely. Europe is hyper-liberal kind of approach. We have 3, 4, 5 operators for each country, which is insane compared to the US. That's got 4 or 5 for the entire United States of America. So Europe is completely mismanaged from a regulatory point of view. We think Europe will change on that. Whether they're going to move from there to actually tax Google and Apple or Netflix for using the bandwidth, I don't know. But the trend is definitely there. So we like TI, both credit and equity. We think, the Vivendi is probably just negotiating, trying to get the best exit. The chance for Vivendi to enter into a big war with the government when they don't even have support by the French government is very low. I think if they do, the Italian government will exercise golden power. So eventually the fixed network will be sold to KKR and another consortium. There is a chance Vivendi joins that consortium. There is also a chance that Vivendi launch a tender offer with some sort of agreement with the government, but we view that as less likely than the other events. The alternative is that nothing happens, new management comes in, and the first thing they're going to say, we need a capital increase because we're over-levered, which would be a disaster for Vivendi anyhow. So we see Vivendi as in the literal kind of a cul-de-sac, and there's very few way to withdraw from that. The best way for them is to increase the price, which I think hopefully will happen. So Vivendi actually will play in favor of the TI stock and credit. It's a position we have predominant in the equity. It's a decent position for us. We think, the return is substantial. The downside is, 20-30% from where we are now. The upside is to double the stock from this point of view. Next is Oi Brazil. Obviously, the fund performance, month to date, we're actually up on the month thanks to several players, but year to date, we're up around 2%. Oi Brazil probably lost 3% this year. Why we still have it, why we want to have it, is because we think it's a great investment now. We have the bonds at 7. Oi Brazil is going through a restructuring with the bondholders and on the other side with the regulators. If both happens, the upside is meaningful. We're talking 25, 30 plus from where we're now. The Oi Brazil is effectively a service co that owns a third of the subsidiary that controls the best fiber optic network in Brazil. So very fast growing country, big demographics, big economic progression with the country. Fiber optic is essential. We think that value of that subsidiary is increasing every day. We are on top of that. We have that as a collateral. There is a decent chance also the regulator agrees with Oi that, what they were asked to pay was too high on some of the concessions. So we see a lot of upside. It's been incredibly painful. And, we thank all the investors that have been with us through that. We think at this point, we really see, we could go down even 50% if it's a liquidation, forced liquidation, go to 3.5 cents on the dollar, which we view as unlikely, given the value of the recovery. But on the other side, if the restructuring goes through as we expect, and the company's already done in the past, I think there is a very, very meaningful upside, 3-4 times where we're now with the position. So we really like it. Away from that, next one that we can talk about is Monte LT2. We've been into Monte for a long time since the capital increase. We bought the bonds at 40 cents. The bonds around 80 to 90 now. We think they're very, very cheap. They're trading at 12% yield to maturity. The government owns 70+% of the bank. Eventually they'll do a placement. If they do a placement above 30% of that size, they eventually will trigger a tender offer on the side of the buyer. If that happens, obviously you would have a situation where the buyer of Monte will actually pay a discount because they're going to get the stocking discount via the placement. And then because the way the law is structured in Italy, the highest you're going to pay is going to be the price of that or the last 6 months weighted average. So overall, we view that as quite positive. We think there's going to be plenty of suitors for Monte. Obviously, it depends what's happening with the market macro picture, but we really like it here. We think, there is, 20 to 40% upside on the bond. The carry is really good, and the bank is improving massively every day, very liquid, one of the best credit profiles of the balance sheet compared to all the entire banking system in Italy and in Europe. So away from that, we have Dish Telecom. We've been out of that position for a long time. We restarted last month. Dish is he's got the most modern cutting edge 5G network in America, in the United States. They still need quite a lot of CapEx to deploy that and to develop it properly. But we think they will get the funding. We bought bonds below 50 cents on the dollar, where if we think the financing will come from other parties, we think there's a very decent chance that the bonds will probably up 40 to 80%. We really like the story. We see the downside relatively limited. Yeah, they could be down probably 30 to 50%, maybe even more in case of liquidation. But we don't see that happening because the interest of most of the long-term investors into the telecom network and telecom facilities, such as in this case, probably the most modern 5G network around in the States. Another name we've been quite involved has been Coinbase. On the next page, Coinbase is a classic, is a good example for us because we've done that for Coinbase, we've done that for Tesla, we've done that for a few other names where the equity valuation is really, really exuberant, if not to say irrational. And on the other side, you have a balance sheet where, like in the case of Coinbase, there is almost more cash than the bonds, but the bonds are trading at 50 cents on the dollar. So we've been trading long on the bond and then short on the equity in and out, depending on different news. Our view on crypto is the same, is that they're not useful. You don't need anything like crypto right now to do any financial transaction. But the reality is if deflation comes like we expect in 2024, we will then see plenty of bids for crypto, which then will create more activity for the exchanges. Even if they're going to be heavily regulated and so on, they're still going to have a reason to exist. Coinbase, the management has been really good at managing the cash and expenses, the cost structure. So it's a perfect play for us, and it's been profitable and keeps on being so. Along the bonds, short the equity, and then obviously depending on the idiosyncratic news or flow of news, we do adjust the delta on the equity. Last but not least, some of the investors that may be listening in has been with us since 2015. We were effectively a rob of our senior bonds in Banco Espirito Santo. We owned the bond in the mid-20. Banco Espirito Santo has been spun off in Novo Banco. Novo Banco just exited this year the European procedure of state aid. The company is doing really, really well, and they are probably considering it an IPO or a sale of the business. The biggest shareholders in Novo Banco are Lone Star, the private equity, and then obviously the resolution fund by the Portuguese authority and Portuguese authority. So when we got effectively bailed in because Novo Banco needed more capital, clearly that valuation at that time was excessively conservative, and that's one of the things that's being challenged. We think there's a high chance now that Novo Banco exits the procedure, that the Portuguese authority will consider some sort of settlement. The non-creditor worse-off minimum recovery for our bonds should be in the low 30s. We're market, mid-20 now. The expectation is some investors think these bonds will get way above par because of the litigation that we're having with the authorities. We've been in one of the bondholders groups since the beginning. We think there is going to be eventually some sort of settlement, which could be probably in the next few, if not years, could be quarters. And I think, we're getting much closer to resolution now because Novo Banco exited the state aid procedure. So the good bank that was spun off is in a very good place now. And then we still have those claims. And so we expect something there. Obviously, it's not a massive position, but we have a few percentage points there for the fund. It could be really good, obviously, because in the best case scenario, we could multiply the money we got. Otherwise, it would be a very comfortable double-digit returns for cash on cash. And with this, I'm closing on both the macro idiosyncratic, and obviously we remain available for any questions, any requests from the investors.
Yeah, just use the chat if you want to make some question. Filippo, I want to ask you about Japan. Of course, we saw a lot of euphoria also on that market. So what's the positioning? You touched it briefly before on the equity, and what do you think with respect to the monetary policy and positioning on the exchange, on the yen?
Yeah, quite a few clients ask us about Japan. Japan for us is a small short now on the equity side. We think, the valuation are very, very stretched. We don't see the real reason macroeconomically for that. We're very bearish on China. We think, we've seen the best post-COVID, and, I think China we've been talking about for a long time, inverted demographic pyramid, plenty of problems there. So we don't see the regional context there to be that supportive for Japan. We think valuation very high. So we're short Nikkei right now as a macro short and macro hedge. And on the other side, on the yen, our expectation is that eventually the central banks will somehow exit or fine tune the band on the rates. And that would create a bid for the yen. Currently, we have a long yen, short sterling kind of position for the book is one of the currencies that we have on the macro side. More to play the gap between the two kind of, macro situation there. Overall, I think Japan is very, very important from a macro point of view, because if they do abandon their ultra expansive monetary policy by abandoning the band or, even changing dramatically, that I think would have a major impact on risky assets globally.
Well, in terms of AI, of course, it's clear that the view is that it would be a big impact looking medium term, but probably now too much excitement for the tech stocks. What's exactly the positioning of the fund? Are you short on the index, on some specific names where the valuation are too high? So just to clarify this.
Yeah, we've been short predominantly through the index now. I mean, since last week on the NASDAQ. We think, it's got to valuation which are very, very, very stretched. And I think AI, very different from what we see in 2000, 2001, a 1 million budget for AI startup can create real damage. It's not like 2001 where you raise a disproportionate amount of money just to get your pets.com website on and make it work. The return on money now, because of the technological developments, is massive. So we expect lots and lots of disruption. Remember, AI has there's no moat, there's no defense, there's no competitive defense. You have each of these big tech giants has got its own AI generic model. Whether it's Google, OpenAI, Alibaba, whoever has got like the software has been developing this for the last 5-6 years. So that is already out there. The question is going to be how you customize it and apply to the specific circumstances, whether it's education, accounting, financial investment, and so on. So we think this is probably going to be close to like a solid $1 trillion of investment in startup over the last 12 months, and it keeps on going. So I think once we see that, capacity coming online, they will be very disruptive. And I think also they will absorb a lot of the cash that is actually chasing the usual suspects. So on that, we're short NASDAQ. We've been developing a few trades, like in the past, we had Tesla, short the equity, long credit. We've been looking at some of the names. Obviously, we've been very careful because at the moment, one thing people don't talk much about AI is very much a meme stock movement. There's been an enormous explosion of single day call option, and it makes sense. AI is real. It's going to be the biggest, technological revolution ever. But I don't think the best way to play is to buy Tesla. Is probably to invest in some startup. But obviously, not everybody can do it. So there's an enormous amount of money flowing to the same situation. What we see now is the combination of these massive exuberance in terms of valuation on the tech level, and on the other side, QT is really picking up with monetary basis going down. So I think the combination of the two, it doesn't bode well for the second half of the year in terms of returns and performance.
The next question is on the financial. Of course, financials have been a good positioning for the funds since the beginning of the year. We understand that you now reduce the exposure, but you still have some idiosyncratic play. What about the US regional banks that nobody talks about these days? Do you have a view on that?
We on the banks, we've been very bearish into the crisis. We had a few shorts. Unfortunately, we had the wrong regional banks in US. I mean, they were down, but not as much as the one that actually collapsed. I think the regional, I mean, the situation, the bank situation in US is real. I mean, there's going to be plenty of credit issues because rates keep on going up, and there's going to be quantitative tightening. And I think AI may not be that good for everybody. So I think the credit crunch from there is going to keep on going. And like we said, there's a dilemma for the Fed because that will be too speculative for them to consider. And they just look at the inflation and, the financial condition being loose. So they're going to keep on increasing rates. It's going to make the credit crunch worse. So we're short banks in US, especially on the equity. We don't have long on US credit banks. We had lots of longs in Europe because we think Europe was associated to the US for the wrong reason. So we played on Credit Suisse senior bonds, did really well on the holdco, and we've been buying a lot of Intesa, BNP, Bank of Ireland. We now sold all of them, so we are totally out of AT1, LT2, apart from Monte dei Paschi and Greece. Greece, because of the changes on the political front, we think Greece is still relatively cheap, and Paschi because it's idiosyncratic, but they are heavily hedged now. So we had a big net long, and we pretty much sold everything. Part because I think there are better ways to play the market now, and then part because I think we've seen the kind of the best of that. I think we're going to go into some sort of recession, and especially for banks. There's going to be a lot of sectors going to be under credit crunch. So you don't really get paid now. I think you don't get the right rewards in the banks. It was a great trade before. Now we liquidated all of that to profit and move on.
And so, Filippo, we are done with the question. I make you just to summarize with a few lines the positioning of the fund, which is a bit careful for the summertime, but with some good opportunity raising up, I would say. But please comment, the last comment on the positioning.
No, it's absolutely true. I mean, I think our view into the summer and to the end of the year, I think it's QT is coming, and I think on the equity we already priced a lot of good events. So I think the combination of the two make us quite bearish overall on overall valuation risky assets. Having said that, we see plenty to deploy capital in terms of special situation, whether it's Ukraine, Argentina, Greek banks, or more distressed situations. I think we see plenty of opportunity there. We do think that the next few months is still going to be tough for central banks to withdraw, to change their picture. But at the same time, deep down, there is this big deflationary wave building up because of different reasons. And obviously the two biggest wild card we look in the market now is one is on the monetary side is Bank of Japan, if and when they decide to do something about the band. And then the second one is the war. And our view on the war, I think I made it pretty clear. I think we're much closer to the end to the beginning. There would be a major driver, obviously, if oil and gas, if Russia is back into the kind of trading system or is expected to be back, even if it's a matter of years, we will see plenty of repricing of many things. Europe will be a massive beneficiary and so on. On the other side, if the war were to get much worse because actually this is going to be an escalation from here, then I think it'll be a problem because we're going into the winter. So I think, again, Europe will be disproportionately affected by that. So overall, caution on the overall valuation, lots of good opportunities, idiosyncratic, and then the view towards the end of the year 2024, we will have plenty of good entry point to get into very long duration, possibly distressed duration, but high quality, and to play the deflationary wave coming from technology, renewable energy, and the war.
Perfect. So thank you everybody for listening, and of course we are always available for further questions. Have a nice day. Thank you. Thank you, Filippo.
Thank you. Thanks everybody. Thanks, Laura. Bye-bye.